Have you ever wondered how investors can tell if a company is really on solid financial ground or maybe heading for trouble? Well, a huge part of the answer lies in one key concept: liquidity. In this explainer, we're going to break down the three essential ratios that give us a really clear picture of a company's short-term financial health.
At its very core, analyzing liquidity answers a super simple but absolutely critical question. Can this company meet its immediate financial obligations? We're not worried about its 5-year plan or its stock price a year from now. We're talking about right here, right now. Can it pay its bills this month? It's really a question of short-term survival.
So what exactly is liquidity? The easiest way to think about it is like a company's emergency fund. It's the cash and other stuff it owns that it can turn into cash very quickly to pay its short-term bills. Things like payroll, rent, and paying its suppliers. A company with strong liquidity, it's like a person with a healthy savings account. They're flexible, and they're ready for whatever comes their way.
Okay, but how do we actually measure this? We can't just glance at a company's financial statements and get a gut feeling. We need a much more structured approach. And that's where a really powerful framework of financial ratios comes into play. These are the tools of the trade, and they give us a standard way to check out a company's liquidity and see how it stacks up against its competitors. Now, the three most common liquidity ratios you'll hear about are the current ratio, the quick ratio, and the cash ratio. Each one gives us a slightly different, and I'd say increasingly focused view of a company's ability to cover its debts. You can think of them as a set of progressively stronger magnifying glasses, where each one gives us a sharper, more detailed look at the company's financial situation. What's really cool about this framework is that it gives us what we call a progressively more conservative view of a company's liquidity. And that's because it's built on a crucial fact. Not all assets are created equal. Some things, like a warehouse full of inventory, just can't be turned into cash in an instant. So as we move through these ratios, the test gets tougher and tougher. Let's see how this works. We start with the current ratio, which is the broadest measure of them all. Then we get a little stricter with the quick ratio, which is also called the acid test ratio. And that one gets tougher because it takes inventory out of the equation. And finally, we have the cash ratio. This is the ultimate stress test. It only looks at the cold, hard cash and cash equivalents that a company has on hand right this second.
So how does all this theory actually play out in the real world? Well, let's take a look at a manufacturing company, where cash is constantly flowing in and out.
For a manufacturer, having strong liquidity is just non-negotiable. They're constantly juggling cash to buy raw materials, cover all their production costs, and sometimes even offer credit to their own customers. Without a solid cushion of liquid assets, just one unexpected problem, like a key machine breaking down or a big customer paying late, could cause a serious cash crunch. It could even threaten the whole company.
So here's the crucial takeaway. Looking at these three ratios together gives you a much richer, more complete understanding of a company's financial health than any single number ever could. It's like going from a flat 2D photograph to a full 3D image of their financial stability. You can see it from all angles and spot potential weaknesses that a single snapshot might completely miss.
But all of this leads to one final and maybe surprising question for you to think about. We've seen that low liquidity is a huge red flag, right? But is it possible for a company to have too much liquidity? Could having a mountain of cash just sitting in the bank actually be a bad sign? A sign of inefficiency or a missed opportunity to invest that money and grow the business? Something to chew on.